All right, buckle up. Ever sent or received a really significant chunk of cash and wondered, does anyone actually track this?
Uh-huh.
You might assume cash transactions are private, but when those dollar bills stack up past a certain point, well, they trigger a fascinating and often surprising set of reporting requirements.
They really do.
Today, we're taking a deep dive into Form 8300. That's the report of cash payments over $10,000 received in a trade or business.
Yeah.
And it's far more than just another IRS document, isn't it? It's really a critical tool in the broader landscape of financial transparency and security.
What's truly compelling about Form 8300, I think, is that it doesn't fit into the typical box of tax forms.
Hmm.
You know, the ones for calculating what you owe or what deductions you can claim.
Right.
In fact, it's not about your tax liability at all. It's a key instrument in a much larger ongoing effort to track specific types of high-value cash transactions. Transactions that could otherwise just move completely unnoticed through the legitimate economy. This isn't just about numbers on a page. It's fundamentally about compliance, yeah, but also detecting unusual financial patterns, and ultimately about safeguarding the integrity of our financial system.
Exactly. It's a shifting perspective, right? We're not talking about your personal finances here, but rather how certain business transactions become these vital pieces of a national puzzle.
That's a good way to put it.
So our mission today is to pull back the curtain on this form. We're going to break down precisely who needs to file it, when they need to do it, and how to get it right. All directly from the IRS's own instructions.
Straight from the source.
Yeah. Consider this your shortcut to being well-informed about a regulation that, perhaps surprisingly, touches a wide array of businesses. This deep dive will guide you through the intricacies of Form 8300, spotlighting the most crucial elements and maybe some common pitfalls.
Definitely some pitfalls to avoid.
We want to ensure you grasp its nuances without feeling overwhelmed. And we'll be focusing specifically on the reporting requirements, because that's the core purpose of this unique document. So let's start at the very beginning, laying the foundation. What exactly is Form 8300?
Okay.
Its full title is, well, it's kind of descriptive, Report of Cash Payments Over $10,000 Received in a Trade or Business. Sounds straightforward enough, maybe?
On the surface, maybe, but the real story, as always, lies in the detail.
Right. This form serves a powerful dual purpose. It's not just for the Internal Revenue Service, the IRS,
Right.
but also for the Financial Crimes Enforcement Network, or FinCEN.
That's the key. FinCEN.
This immediate involvement of two distinct, powerful agencies, one focused on tax, the other on financial intelligence that instantly signals this form, is about much more than just your typical income tax declaration.
Absolutely. And for those of you trying to stay current, the version of Form 8300 we're discussing, the one revised in December 2023, that's specifically for transactions occurring after December 31st, 2023.
Good point. So if you're handling significant cash payments now, this is the guidance you really need to understand.
That dual purpose is absolutely foundational. And it leads us directly to the strong legal basis underpinning this requirement.
Okay.
Form 8300 isn't just some IRS whim. It's mandated by two very powerful pieces of U.S. law. You've got Section 6050I of the Internal Revenue Code, which governs tax reporting, and maybe more significantly, 31 U.S.C. 5331, which falls under the Bank Secrecy Act.
The Bank Secrecy Act. Okay, that tells you something.
It really does. If we connect this to the bigger picture, these legal requirements exist for a profoundly serious reason: to combat illegal activities that thrive on anonymity.
Like what?
Well, we're talking about the murky worlds of money laundering, drug trafficking, corruption, and the financing of terrorism.
Right, serious stuff.
Exactly. What's truly insightful is how a seemingly simple business transaction becomes a critical data point for national security. Every time one of these forms is filed, it's like a new piece snaps into a complex financial puzzle. These pieces, collected across thousands of businesses, often reveal patterns that lead to significant busts. For instance, without this kind of reporting, it would be far easier for illicit funds from, say, a drug cartel or a terrorist cell to move undetected through the legitimate economy.
Making it harder to catch them.
Incredibly difficult to detect, prosecute, and ultimately dismantle. It's about creating a trail, a digital breadcrumb, for transactions that might otherwise be completely untraceable.
That puts a whole new dimension on it. It's less about the individual business payment and more about building a broader intelligence picture.
Precisely.
So given that, who are the boots on the ground in this fight? Who has to file this form? How broadly does that net get cast?
Okay, the instructions are quite specific here. Any person engaged in a trade or business who receives more than $10,000 in cash,
Okay, over 10 grand.
whether in one single transaction or in two or more related transactions, must file.
All right, but what do those terms actually mean? Let's start with trade or business. What counts?
Trade or business is defined pretty broadly by the IRS. Generally, it refers to any activity carried on for the production of income from selling goods or performing services.
So not just huge corporations.
No, definitely not. It applies equally to a sole proprietor, a small business owner, or even an individual regularly engaging in an income-producing activity. It's designed to capture recurring commercial activities, not like a one-off sale of your old car from your personal garage.
Okay.
If you're consistently selling goods or providing services with the intent of making a profit, you likely fall into this definition.
And then there's the concept of related transactions. This sounds like where it could get tricky. It seems like a common area for businesses to trip up. What constitutes related in the IRS's eyes?
Yeah, this is crucial. The instructions clarify this quite well, and it's essential to grasp to avoid accidental noncompliance. First, any transactions conducted between a payer and the recipient within a 24-hour period are always considered related.
Always. Within 24 hours.
Always. So if a customer buys an expensive piece of furniture from your store for, say, $6,000 in cash, and then comes back 3 hours later to buy another item for $5,000 in cash, those are automatically related. The total is $11,000. That triggers the reporting requirement within that 24-hour window.
Got it. What about over a longer period?
Okay, second point. Transactions are also considered related even if they occur over a period of more than 24 hours. If the recipient knows, or has reason to know, that each transaction is part of a series of connected transactions.
The reason to know part.
Exactly. This rule is specifically designed to prevent people from trying to structure transactions, breaking them down artificially into smaller amounts, often just under the $10,000 threshold, specifically to avoid the reporting requirement.
Trying to fly under the radar.
Precisely. The IRS explicitly states that a single transaction cannot be artificially broken down to avoid reporting. So, for example, if a client is buying a $15,000 piece of equipment from you, and they offer to pay $7,000 this month and $8,000 next month, and they specifically mention they want to keep it under the radar, that knowledge makes the transactions related, even if they're separated by weeks.
Wow. So the intent matters.
The intent, or even just having reason to suspect that intent, matters. This is a crucial point for compliance, as structuring is a serious offense. Businesses need to be vigilant for anything that feels like an attempt to circumvent the rules.
That's a vital distinction, and it puts a lot of responsibility on the business owner to be aware. Beyond general businesses, are there any specific types of filers that have unique requirements?
Yes, there are two notable examples with very specific mandates. First, court clerks.
Court clerks, okay.
Clerks of federal or state courts have a unique and strict requirement. They must file Form 8300 if they receive more than $10,000 in cash as bail for an individual charged with a specified criminal offense.
Not just any bail payment, then?
No. Both the dollar threshold and the specific type of crime criteria must be met. Specified criminal offense means federal crimes involving controlled substances, racketeering, or money laundering, or any state criminal offense that is substantially similar to those federal offenses.
Gotcha.
And for these purposes, clerk includes the clerk's office or any other office, department, unit of the court authorized to receive bail. It's a very specific carve-out designed to track funds related to serious criminal activity.
Makes sense. And the second example?
Second, casinos. Now, while casinos have their own separate, very stringent FinCEN reporting requirements for their gaming activities, like chip purchases.
Right, they have CTRs and SARs.
Exactly. But they must still file Form 8300 for cash payments received in their non-gaming activities.
Like what? Restaurants? Shops?
Precisely. If a casino operates high-end restaurants, luxury shops, nightclubs, or even a spa on its premises, and they receive over $10,000 in cash for services or goods from those parts of their business, they are subject to Form 8300 filing, just like any other trade or business.
So it covers all the other revenue streams.
Right. The ones that might otherwise fly under a different regulatory radar.
That makes perfect sense. Ensures consistency. Now, this next point is quite interesting. Voluntary reporting. Why on earth would someone voluntarily file a Form 8300, especially if they're not legally required to?
It sounds counterintuitive, right?
Yeah.
But you might choose to do so for any suspicious transaction, even if the total amount of cash doesn't hit that $10,000 threshold.
Okay. Why?
This ability to voluntarily report is primarily for FinCEN and the IRS to use in their ongoing efforts to combat financial crime. It raises an important question, though. What exactly constitutes a suspicious transaction?
Yeah, what is suspicious?
The instructions provide a broad yet helpful definition. It's a transaction where it appears that a person is trying to cause Form 8300 not to be filed, or maybe trying to file a false or incomplete form.
Okay, so trying to cheat the system.
Right, but it also includes any transaction that otherwise appears suspicious for any reason. That's broad.
Very broad.
It gives businesses a lot of latitude to flag unusual activity. For instance, if a customer insists on paying in cash for a high-value item, maybe refuses to provide identification, or seems unusually anxious about the whole thing. Even if the amount is only, say, $8,000, a business might choose to voluntarily report it. Or maybe they offer a significant premium just to pay in cash for something usually paid digitally.
Interesting.
These aren't hard and fast rules, more like red flags that prompt a business to consider whether something just feels, well, off. It's a key part of their role as an unofficial front line in financial transparency.
Okay, let's unpack this. When we say cash for Form 8300, my mind immediately jumps to, stacks of paper money, greenbacks.
Sure, that's the first thing people think of.
But given the complexities we've already seen with this form, I'm guessing the definition goes way beyond just physical bills. What are we really talking about here?
You're absolutely right to question that because it's precisely where a lot of people get tripped up. While physical bills and coins are definitely cash, that's the core definition, U.S. and foreign coin and currency received in any transaction.
Right, the obvious stuff.
The IRS's definition extends significantly into what they call monetary instruments. And this is where it gets really nuanced and critical for compliance.
Monetary instruments. Okay, so not just greenbacks. What kind are we talking about?
We're talking about things like a cashier's check, a money order, a bank draft, or a traveler's check. These can be considered cash under Form 8300 rules.
Can be, so not always.
Exactly. There are very specific conditions. It must have a face amount of $10,000 or less.
Okay, under 10,000.
And it must be received in connection with what the IRS calls a designated reporting transaction. We'll get to what that means. Or the other figure is if the recipient knows it's being used in an attempt to avoid the reporting requirements, regardless of the amount.
Ah, that avoidance thing again.
Right, so imagine a scenario. A customer wants to buy a luxury watch for $12,000.
Okay.
They try to pay with 3 separate cashier's checks, each for $4,000, maybe from different banks.
Trying to break it up.
Exactly. Even though each check is under $10,000, because they are being used for a single designated reporting transaction, buying the watch, and potentially to circumvent the reporting threshold, they would be aggregated and count as cash for the purpose of this form. The total is $12,000.
That's a huge point. So it's not just physical bills, but specific types of bank instruments too, under very particular conditions. What about a regular personal check? Like if I write you a check for my checking account, is that ever considered cash? This seems like a common point of confusion.
Crucially, no. A check drawn on the payer's own account, like a personal check, a business check from their own account, or even a certified check drawn on a personal account, is never considered cash for Form 8300 purposes. Doesn't matter the amount.
Never. Even if it's for like $50,000?
Never. This is a really common misconception, and understanding this distinction can save businesses a lot of headaches.
Okay, why is that? What's the logic?
Well, think of it this way. A personal check is effectively an IOU, right? It's a promise to pay from your own bank account. It's not actual currency that's immediately transferable in the same way.
Gotcha.
But certain official bank instruments, like cashier's checks, they're closer to guaranteed funds. They can act as cash surrogates in specific scenarios, especially when the IRS is trying to track attempts to move illicit funds discreetly.
So the source of the funds behind the check matters?
In a way, yes. If a customer pays you $50,000 for an item with a personal check, that doesn't trigger Form 8300. But if they pay you with, say, 5 $3,000 cashier's checks for a qualifying item,
Qualifying item.
that potentially does trigger the reporting because those cashier's checks might count as cash in that context.
Okay, so that brings us to this term you mentioned, designated reporting transaction. That sounds like the key differentiator for when those monetary instruments actually count as cash. What exactly does that mean?
You've hit on the core of the nuance. A designated reporting transaction is basically the IRS's way of saying, look, we're specifically watching cash-like payments for certain types of big-ticket, maybe easily resaleable items or services, because those are often used to move illicit funds.
Okay, makes sense.
It's defined as a retail sale, or the receipt of funds by a broker or other intermediary in connection with a retail sale of one of three specific categories:
Three categories. What are they?
a consumer durable, a collectible, or a travel or entertainment activity.
So it really narrows down the types of transactions where those monetary instruments count as cash. Let's break down those three categories. Start with retail sale. What's that?
A retail sale is defined as any sale made in the course of a trade or business, if that trade or business principally consists of making sales to ultimate consumers and users.
So like a regular store selling to customers.
Exactly. It doesn't matter if the sale is technically for resale or any other purpose, as long as your business primarily sells directly to end users. To think car dealerships, jewelry stores, high-end art galleries, furniture stores. They'd generally be engaged in retail sales.
Okay. And what about a consumer durable? Give us some concrete examples.
Sure, a consumer durable is tangible personal property, something you can touch.
Huh?
That, under ordinary usage, you'd reasonably expect to remain useful for at least 1 year.
Okay. Last a while.
And that has a sales price of more than $10,000.
Over 10 grand again.
Right. So think luxury cars, boats, expensive specialized machinery, maybe for a small business, high-value heavy equipment like a tractor, or even a large custom-built RV.
Got it. So if I'm a boat dealer.
Exactly. If you're a boat dealer and a customer pays $15,000 for new vessels using $8,000 in currency and a $7,000 cashier's check, that cashier's check is counted as cash because it's part of a designated reporting transaction, retail sale, for consumer durable, the boat, and the total cash received, $8 currency plus $7 cashier's check equals $15, exceeds $10,000. So you'd file.
Okay, that makes sense. What about a collectible?
A collectible is pretty intuitive. It aligns with what most people would expect. It includes any work of art, rug, antique, metal, like gold bullion, gems, stamps, or coins.
So things people collect.
Pretty much. If you're a dealer in rare coins and someone pays you $12,000 for a rare coin collection with a mix of currency and, say, a money order, that money order would definitively count towards the cash total, triggering the Form 8300 requirement. Same goes for an antique dealer selling a valuable piece of furniture or a sculpture for over $10,000 involving one of those monetary instruments.
Got it. And finally, travel or entertainment activity. What falls under that?
This refers to an item of travel or entertainment that pertains to a single trip or event.
Single trip or event.
Right. The crucial part here is that the combined sales price of the item and all other related items for the same trip or event sold in the same or related transactions must exceed $10,000.
Combined price, okay.
Yeah, so if you're a luxury travel agent selling an exclusive safari package to someone for $20,000.
That's the trip.
Right, and the client pays a portion of that with a cashier's check and the rest in currency. That cashier's check would be considered cash because it's for a designated reporting transaction.
Other examples?
Maybe a high-end private concert experience, a big catered corporate event package, a luxury cruise. As long as the cost exceeds the threshold and involves these specific monetary instruments, plus maybe some actual currency.
This is incredibly detailed. It really highlights the precision required.
Yeah.
Are there any specific exceptions where these monetary instruments are not considered cash, even if they fit one of those categories? Like if the check comes directly from a bank loan?
Yes, absolutely. That's a key exclusion. It's important to understand these. A cashier's check, money order, bank draft, or traveler's check is not considered received in a designated reporting transaction if it constitutes the proceeds of a bank loan.
Ah, okay.
So if someone takes out a car loan from a bank and the bank issues a cashier's check directly to you, the car dealer, as part of the loan disbursement.
Standard practice.
Right. That specific cashier's check isn't treated as cash for Form 8300 purposes. The intent here is clear. The IRS is trying to track unusual cash-like payments, not standard, traceable financial transactions, like the direct disbursement of loan proceeds.
That makes sense. Any others?
Yeah, the same logic applies if the instrument is received as a payment on certain promissory notes or installment sales contracts, or maybe down payment plans where the funds are coming from a formalized, trackable financial arrangement. And it's not seen as an attempt to move undeclared cash.
Okay.
Understanding these precise definitions is absolutely key to ensuring compliance and avoiding errors in reporting. The golden rule here is personal checks are never cash. Got it. But official bank checks can be if they're $10,000 or less and linked to specific high-value retail purchases, durables, collectibles, travel, entertainment, or if you know someone's trying to get clever to avoid reporting.
So we've navigated the tricky definitions of cash and identified who must file. Now let's get down to the practicalities. Assuming you've received the qualifying cash, what's the timeline for sending this form off, and how do you actually submit it? This is where the rubber meets the road for compliance, right?
Absolutely. The timeline for filing is quite strict, so, punctuality is really paramount to avoid penalties. You must file Form 8300 by the 15th day after the date you receive the cash.
The 15th day after receiving it?
Okay.
Right.
And if that 15th day happens to fall on a Saturday, Sunday, or a legal holiday, then the due date automatically shifts to the next business day.
Good to know.
But yeah, it's a hard deadline, so marking your calendar immediately upon receiving those triggering payments is definitely a good practice.
And what if the cash comes in multiple payments, say, for the same big project? Does that change the filing trigger or the due date?
Yes. This brings us to the crucial aggregation rule for multiple payments. This trips people up sometimes.
Okay, how does it work?
If you receive more than one cash payment for a single transaction or for related transactions, you must report the multiple payments anytime the total amount of cash exceeds $10,000 within any 12-month period.
Within any 12 months. Got it.
Right. And the clock for filing starts ticking within 15 days of the date you receive the payment that causes the aggregate amount to exceed $10,000.
Okay, can you give an example? That sounds like it could get complicated.
Sure, let me give you a concrete example. Imagine you're a landscaper working on a large project for a client. Total cost is $25,000.
Okay.
They give you an initial cash payment of $7,000 on January 1st for the initial design.
Under the limit, so no filing yet.
Correct. You don't file yet.
Oh.
Then, 2 months later, on March 1st, they give you another $4,000 in cash for the same project.
Now the total is $11,000.
Exactly. At this point, the total cash received for that related transaction is $11,000, which has now crossed the $10,000 threshold. So Form 8300 would be due 15 days after March 1st.
And what if they pay more later?
Good question. If you receive additional related payments after that, say another $5,000 in cash later in the year for the same project, you would need to file another Form 8300 within 15 days of that payment, reporting the new $5,000. This continuous aggregation ensures that large cash movements are consistently tracked over that 12-month window.
Okay, so potentially multiple forms for one big transaction paid over time?
Potentially, yes, if subsequent payments also cross the $10,000 threshold in aggregate with other payments within a 12-month period. Now, if you find yourself in a situation where multiple reports for different transactions become due within a tight 15-day window, the IRS does allow you to file a combined report.
Oh, that's handy.
Yeah, but it must be filed no later than the earliest due date if those reports have been filed separately. Offers a bit of flexibility for businesses with frequent triggering events.
That's incredibly helpful for businesses with ongoing transactions. Now, a significant update for many businesses involves how these forms are filed. There's been a big shift towards electronic filing, correct?
Absolutely. This is a critical what's new for transactions occurring after January 1, 2024.
Yeah.
Electronic filing of Form 8300 is now required.
Required, not optional.
Required if you are already obligated to file certain other information returns electronically.
Like what kind of returns?
This typically includes forms like Forms 1099, reporting various types of income like payments to independent contractors, or Forms W-2, which report wages.
Okay, so what's the trigger? How many of those other forms?
The key threshold for this electronic filing mandate is if you file at least 10 information returns of any type. And this specifically excludes Forms 8300 themselves when counting towards the 10.
Okay, don't count the 8300s for this threshold.
Right. If you file 10 or more of those other types of information returns in aggregate during the calendar year, then you must e-file all of them, including any Forms 8300 that you are required to file.
Can you give us a couple of clear examples just to really nail down that threshold? It sounds like it could be confusing.
Certainly. Let's use the IRS's own examples to make it super clear.
Okay.
Example 1. Imagine your business files 5 Forms W-2 for your employees and 5 Forms 1099 INT for interest payments during 2024.
Okay, 5 plus 5, that's 10.
Exactly. That totals 10 returns.
Mm-hmm.
Because you've met the threshold, you are now required to electronically file all your information returns for that year, including any Forms 8300 you might also be required to file.
Got it. Example 2.
Example 2. Now, let's say your business files 3 Forms 1099 MISC for miscellaneous payments and 4 Forms 1099 DIV for dividends during 2024.
3 plus 4, that's only 7.
Right, a total of 7 returns. In this scenario, you would not have met the 10 return threshold, and thus you are not required to electronically file your information returns, including Form 8300 during 2024.
But you can still e-file if you want to.
Oh, yeah, absolutely. E-filing is always an option, and honestly, it's generally encouraged for its efficiency and accuracy. The crucial point here is that the number of forms 8300 you file does not count towards the electronic filing threshold for other information returns. It's the other returns that drive the Form 8300 e-filing requirement.
Okay, and what system do you use for e-filing?
The system for electronic filing is the FinCEN Bank Secrecy Act, or BSA, e-filing system.
FinCEN system, okay. That distinction about the threshold is really important and could easily be misunderstood. So, what if e-filing presents a legitimate problem for a business? Maybe they don't have reliable internet, or are there any waivers or exemptions from this electronic filing mandate?
Yes, there are provisions for those circumstances. For waivers, you can request one due to undue hardship.
Undue hardship, how do you do that?
This is done by filing Form 8508, which is the application for waiver from electronic filing of information returns. Now, the good news here is that if you are granted a waiver from electronically filing any other information return, that waiver automatically extends and applies to any Forms 8300 you are required to file for that calendar year.
Okay, so you don't need a separate waiver just for the 8300.
Correct. You cannot, however, request a waiver specifically only for Form 8300. If a waiver is granted and you end up filing on paper, you must clearly write "waiver" on the center top of page 1 of each paper Form 8300 you submit.
Got it. What about exemptions?
For exemptions, there's an automatic exemption if using the technology required for electronic filing conflicts with your religious beliefs.
Okay.
In this specific case, you must include the words "religious exemption" on the center top of page 1 of each Form 8300 when submitting it on paper.
And if you're just not required to e-file, or you have a waiver or exemption?
Then you would file paper Forms 8300 with the IRS. The instructions provide a specific address, currently the IRS Detroit Federal Building address.
Okay. And what happens if a form is filed late? Or maybe in the wrong manner, like submitting a paper form when electronic filing was actually required?
Right. You must identify late filed returns, and the IRS takes this seriously. If you file a late Form 8300 electronically, you include the word "late" in the comments section of the return.
Okay.
If you file a late Form 8300 on paper, you must clearly write "late" on the center top of page 1.
Yeah.
And it's critical to understand this. Failure to file timely includes a failure to file in the required manner.
Ah, so filing on paper when you should have e-filed counts as late.
Exactly. Even if you mailed the paper form by the 15-day deadline, if you were required to e-file, that form is considered late and will be subject to penalties. It's not enough to simply meet the due date. You have to meet the filing method requirement as well.
That's a really important detail. And finally, for retention, once you've filed, how long do businesses need to keep copies of these forms? Is it the standard 3 years?
No, it's longer for this one. Yeah. You must keep a copy of each Form 8300 for 5 years from the day it was filed.
5 years.
Yeah. This is crucial for your internal records, especially in case of an audit or maybe an inquiry by the IRS or FinCEN down the road.
And if you e-file, what constitutes a copy?
Good question. If you're filing electronically, ensure you save a complete copy of the form prior to submission. A simple confirmation number or a message saying it's been filed is not a substitute for having a copy of the actual form itself with all the data you entered.
Right, need the actual detail.
Exactly. The IRS highly recommends associating the confirmation number you get from the e-filing system with your saved copy of the form. Just makes it easier to track and reference later. It's a small detail that can save you immense hassle down the line.
Okay, here's where the rubber truly meets the road. We've talked about the what, the why, the when, and the how of filing. Now, let's actually walk through the form itself. We won't read every single line item, obviously.
No, that would take forever.
Right. But let's focus on the most critical sections, maybe highlight some common pitfalls, just ensuring you know exactly what information goes where and, maybe more importantly, why it matters.
Sounds good. The general principle, as you fill it out, is that all parts of the form must be completed. You can't just skip sections unless there's a specific instruction allowing it. For example, you can skip Part 2 if the individual named in Part 1 is conducting the transaction solely on their own behalf.
Okay, so if the person giving you the cash is the actual buyer, not an agent, you skip Part 2.
Correct. Let's navigate the form's key areas.
Yeah.
First, right at the top, you'll see Item 1, Amends Suspicious Transaction. 2 little check boxes.
Okay.
Box 1A, Amends Prior Report. Check this if you're correcting a form you already filed. Maybe you found an error later.
And if you check this...
It's vital to remember you must complete the entire form again with the corrected information. You don't just send in the correction or attach the original. You redo the whole thing with the right info.
Got it. A complete do-over.
Yep. Box 1B, suspicious transaction. Check this box if you're voluntarily reporting a suspicious transaction, or if a transaction you have to report is also suspicious.
And if you check this suspicious box,
You must describe in the comments section, which is on page 2, why you think it's suspicious. Give some detail. The IRS also notes that you might want to report suspicious activity to your local IRS Criminal Investigation Division, and if there's an imminent threat, like terrorism financing, report immediately to local law enforcement too.
okay, so checking that box triggers extra steps and scrutiny.
Exactly. It flags it. Next, we move to part 1. Identity of individual from whom cash was received. This is all about the person who physically handed you the cash.
The person standing in front of you.
Precisely. The absolute non-negotiables here are items 3 to 5, last name, first name, middle initial, and most critically, item 6, the taxpayer identification number, TIN.
TIN. That's usually the social security number for an individual.
Right. For individuals or sole proprietors, it's their SSN or an ITN, individual taxpayer identification number. For other types of persons like corporations or partnerships handing you cash, which is less common but possible, it's their EIN, employer identification number.
What if you can't get the TIN? This seems like a potential problem area.
It is. This is a common pitfall. The instructions are clear. You are required to furnish the correct TIN. You should request it from the person. If you've requested it but are unable to get a TIN for one or more parties within that 15-day filing window, you must still file the report on time. Don't delay filing just because you don't have the TIN.
So file it anyway. What do you put in the TIN?
You leave the TIN box blank in that case, but you must use the comments section on page 2 to explain why the TIN is not included. You need to show you attempted to get it.
Okay. Document your efforts.
Exactly. This isn't an out from filing. It's a procedural workaround for a temporary obstacle. Now, there is an exception for certain non-resident aliens or foreign organizations without U.S. ties. They might not be required to provide a TIN.
Okay. What else in part 1 is crucial?
Item 13, occupation, profession, or business. You need to be specific here. Plumber, attorney, antique dealer, car dealer. Don't just put vague stuff like business person or self-employed. The IRS wants to understand their line of work.
Gotcha. Be specific.
And then item 14, identifying document ID. This is incredibly important for verification and another common area for errors.
Why?
Because you must verify the name and address of the person in part 1. You do this by examining a document normally accepted for identification, like a valid driver's license, a passport, maybe an alien registration card.
Okay, check their ID.
And then you have to provide 3 pieces of information from that ID. 14A, describe the ID, e.g. driver's license. 14B, identify the issuer, e.g. state of Utah. And 14C, enter the document number.
All 3 parts.
All 3 sub-items are mandatory for the form to be processed correctly. Just getting the license number isn't enough. Failure to complete all 3 is a big red flag for the IRS, signaling you might not have done proper due diligence.
Okay, good to know. Moving on to part 2. Person on whose behalf this transaction was conducted. You said we skip this if the person in part 1 is acting for themselves.
Correct. This section is only for situations where the person giving you the cash is doing it for someone else, like an agent acting for a principal or an employee making a purchase for their company.
So who the money really belongs to, or who the transaction is ultimately for.
Exactly. If you fill this out, the key fields are item 1619 for the last name, first name, MI, or the organization's name, along with their taxpayer identification number, TIN.
Same TIN rules apply here.
Generally, yes. SS NITIN for individuals, EIN for organizations. If it's a sole proprietor who has both an SSN and an EIN, the instructions say provide both.
Okay. And item 27, alien identification.
Similar to part 1, if this person or organization isn't required to furnish a TIN, like a foreign entity without U.S. ties, you'll describe their official identification document, the country that issued it, and the document number.
Got it. Next up, part 3, description of transaction and method of payment. This is where you detail the actual deal.
Right. Key items here. Item 28, date cash received. Put the specific date you got the cash. If it was multiple payments aggregating over $10,000.
Use the date it crossed threshold.
Exactly. Enter the date you received the payment that caused the combined amount to exceed $10,000.
Okay. Item 29, total cash received.
This is the aggregate amount of cash received as of the reporting date. If you file a previous Form 8300 for related payments and then received more related cash payments later that push the total over $10 again within a new 12-month period, you'd report the total amount of those new payments here in the new form. It keeps tracking the flow.
Right, that aggregation rule again. What about item 32? Amount of each form of cash received. This sounds detailed.
It is, and it requires a precise breakdown. You need to separate out U.S. currency and specifically note the amount received in $100 bills or higher. Foreign currency, specifying the country and its U.S. dollar equivalent, and then list each type of monetary instrument that qualifies as cash, cashier's check, money order, bank draft, traveler's check.
And for those checks and money orders.
This is vital. You must provide the issuer's name and the serial numbers of each individual instrument.
Each one.
Yes. This is critical for the IRS and FinCEN to track those specific funds. The sum of all these amounts you list in item 32 must equal the total cash amount you put in item 29.
What if you have, like, 20 money orders? Is there space?
Good question. If you don't have enough space on the form for all the serial numbers, you continue the list in the comment section on page 2. Just make sure you reference item 32 so they know what it relates to. This is another area where incomplete information can cause a big problem.
Okay. And item 34, specific description.
This is where you add more details about what was bought or paid for. Serial numbers for vehicles, VINs, property addresses for real estate transactions, docket numbers for court bail payments. The more specific, the better. Helps identify the underlying transaction clearly.
Makes sense. Finally, part 4, business that received cash. This is about my business, the filer.
Correct. This section identifies your business.
Key things here.
Item 35, name of business. Your full legal name. Item 36, employer identification number, EIN. Social Security number, SSN. If you're a sole proprietorship, you must enter your SSN. If your business also has an EIN, provide both. All other business entities, corp, partnerships, LLCs, taxed as corp partnerships, must enter their EIN. Item 41, nature of your business. Similar to the individual's occupation in Part 1, provide a clear, specific description. Attorney, jewelry dealer, used car dealer, financial consultant. Avoid vague terms like business or store. Helps the agencies understand the context. Item 42, signature and declaration. This isn't just a formality. The form must be signed by an individual who's been authorized to do so for the business. By signing, they declare under penalties of perjury that the information is true, correct, and complete to the best of their knowledge.
Serious declaration.
Very. And don't forget the comment section, page 2. We mentioned using it for explaining missing TINs or suspicious activity. But it's also where you'd note if the transaction involves a related party transaction, as defined by the tax code, IRC 267B. Or if your business is part of a consolidated group, you include the common parent's name and EIN here. And if you're paper filing late or under a waiver, you write late or waiver here too. It's limited to 720 characters, so be concise but clear. It can really help prevent follow-up questions.
That's an incredible breakdown. It really shows the level of detail required, and maybe more importantly, where businesses are most likely to make critical errors.
Yep.
Like not fully completing item 14, the ID part, or stumbling over the TIN requirement.
Absolutely. If I had to pick the biggest blind spots, it's often item 14, getting all 3 pieces of ID info and handling the TIN requirement correctly.
Why those two specifically?
Item 14 is the IRS FinCEN's primary way to verify who gave you the cash. Incomplete info there is a huge red flag, and the TIN people sometimes just give up if the customer refuses. But you must try, document it, and file anyway. Just leaving it blank without explanation or not filing because you couldn't get it, that's asking for trouble. These details seem small, but getting them wrong is often the quickest way to attract unwanted attention.
Okay, so filing the form correctly is step 1, but this isn't just about sending a form to the IRS and FinCEN and then, wiping your hands clean, right?
Not at all. Compliance extends beyond just hitting submit.
There's a vital communication piece with the person who actually gave you the cash, and critically, we need to understand the significant consequences if things go wrong.
You've hit on a truly crucial point. First, let's talk about the statement to be provided to the payer, the person whose name is on the form.
Okay, what's required there?
You must give a written or electronic statement to each person named on the required Form 8300. This isn't optional.
When is this statement due?
It's due on or before January 31 of the year, following the calendar year in which the cash was received. So for any transaction in 2024 that triggered a Form 8300, the statement would be due by January 31st, 2025.
Okay, so they have noticed that it was reported.
Exactly. It ensures the payer is aware that their large cash transaction has been reported to the government.
What needs to actually be in that statement to meet the
The
requirements?
statement must include your business name, your business telephone number, your address, the aggregate amount of reportable cash you received from that specific person during the year, and a clear indication that this information was furnished to the IRS.
Pretty straightforward info.
Yes. And you should also keep a copy of this statement for your own records for at least 5 years, just like you keep the Form 8300 itself.
Okay. Are there any special considerations for this statement, particularly if the transaction was flagged as suspicious back on item 1B? I'd imagine that could complicate things.
Yes, very important ones. And they're designed to protect the integrity of potential investigations. First, you should not provide this statement to any named person if you made a voluntary filing of Form 8300 solely because you reported suspicious activity. Eddie, it was under $10, but suspicious.
Okay, no statement for purely voluntary suspicious reports.
Correct. Now, for all Forms 8300 that were required to be filed, over $10, the statement you provide to each named person must not indicate if you, the filer, noted the transaction was suspicious on the form itself.
Ah, so you don't tell them you checked the suspicious box.
Exactly. The goal here is intelligence gathering without tipping off potential illicit actors that their activities might be under scrutiny.
That makes sense. Anything else about the statement? Should you just give them a copy of the Form 8300?
While it's not strictly prohibited, providing a copy of the actual Form 8300 itself to the named person is not advisable. Because the form contains sensitive information, like your business's EIN or SSN, potentially information about other related parties in Part 2, information the payer doesn't necessarily need to see. You only need to provide the specific summary information required by the instructions, your contact info, the cash amount, and the fact it was reported to the IRS.
That's a strong warning and good practical advice. Now, shifting gears a bit, are there any situations where Form 8300 is not required, even if over $10,000 in cash is received? I'm sure there must be some logical exceptions to prevent redundant reporting.
Yes, there are several key exceptions to reporting. These generally aim to prevent double reporting or cover scenarios that are outside the scope of the illicit financial activity. Form 8300 is really designed to target.
Okay, like what?
First, if the cash is received by a financial institution like a bank that is already required to file a FinCEN currency transaction report, often called a CTR, FinCEN Report 112, for that same transaction. Banks have their own, often more stringent, reporting rules under the Bank Secrecy Act.
Okay, avoids double reporting.
Exactly. Second, if the cash is received by a casino but only as part of its gaming business, like buying chips, provided it's already required to file or is exempt from filing, that FinCEN Report 112 for the gaming activity.
But they still file for non-gaming stuff.
Correct. As we discussed earlier, they still file Form 8300 for non-gaming activities like big cash payments at their hotel, restaurants, or shops.
Got it. What else?
Third, if the cash is received by an agent from their principal, if that agent then uses all of that cash within 15 days in a second transaction, that is also reportable either on another Form 8300 or a FinCEN Report 112, and the agent discloses all the necessary info about the original principal, Part 2 info, to the recipient in that second transaction. It basically passes the reporting obligation down the line.
Prevents the same cash being reported twice as it moves quickly.
Right. Fourth, for transactions occurring entirely outside the United States. This generally means transactions where neither the business nor the payer has a U.S. presence during the transaction. Be careful with U.S. territories like Puerto Rico, though. Special rules might apply, so check IRS Pub 1544.
Okay. And one more.
And finally, if the transaction is not conducted in the course of a person's trade or business. As we defined earlier, Form 8300 applies only to transactions within the scope of an ongoing income-producing trade or business. That personal sale of your old car for $12,000 cash probably doesn't trigger it for you, the seller, unless you're a car dealer, of course.
Those exceptions definitely provide clarity and prevent unnecessary reporting. But what happens if a business fails to comply? If they just don't file or file late or file incomplete? What are the penalties for non-compliance? This sounds like where the implications could get very serious.
They could be substantial, absolutely. And they really underscore the gravity with which the IRS and FinCEN view these reporting obligations. You may be subject to penalties if you fail to file a correct and complete Form 8300 on time, and you cannot show that the failure was due to reasonable cause.
Reasonable cause. We'll come back to that. What about the statement to the payer?
Same applies. Penalties can hit if you fail to furnish a timely, correct, and complete statement to each person named in a required report.
How big are these penalties?
There's a minimum penalty of $25,000 that can be imposed if the failure is due to an intentional or willful disregard of the cash reporting requirements.
25 grand minimum for intentional disregard. Wow.
Yeah, this isn't just a slap on the wrist, it's a significant financial hit. It reflects a determination by the agencies to deter people from deliberately ignoring these rules.
And is that it? Just financial penalties?
Oh no. Beyond just financial penalties, there are much more severe consequences for other violations, potentially leading to criminal prosecution.
Criminal. Like jail time.
Potentially, yes. This applies if someone causes or attempts to cause a trade or business to fail to file a required report, causes or attempts to cause a trade or business to file a required report containing a material omission or misstatement of fact, or, and this is a big one, structures or attempts to structure transactions to avoid the reporting requirements.
Structuring again. Breaking down payments to stay under $10.
Exactly. That's a classic money laundering tactic, and the government takes it very seriously.
What kind of criminal penalties are we talking about?
These violations can lead to serious criminal prosecution. Upon conviction, penalties may include imprisonment of up to 5 years or fines of up to $250,000 for individuals and $500,000 for corporations, or potentially both imprisonment and fines.
5 years in prison for structuring. That's chilling.
It really highlights that these rules aren't just about paperwork. They're about preventing serious criminal activity. The message is deterrence, yes, but also very clearly about catching malicious actors who intentionally try to subvert the financial system.
Wow, okay. Those are incredibly serious consequences, way more than just a simple fine. That really highlights just how important diligence and full compliance are. Can a business get relief from these penalties? Perhaps if it was an honest mistake or some unavoidable circumstance. You mentioned reasonable cause.
Yes, there is a pathway for relief through establishing reasonable cause. Penalty relief can be granted if the filer exercised ordinary business care and prudence in determining their filing obligations, but was nevertheless unable to comply.
How do you show that?
The filer needs to establish either that there were significant mitigating factors regarding the failure, or that the failure arose from events entirely beyond the filer's control, like a natural disaster destroying records right before the deadline, perhaps.
Okay.
Crucially, the filer must also demonstrate that they acted in a responsible manner both before and after the failure occurred.
What does responsible manner mean in this context?
It means having proper procedures in place to ensure compliance, maybe training staff on the requirements, acting promptly to request necessary information like TINs, and attempting to correct any issues as soon as they are discovered. It's not an easy standard to meet, and it requires robust documentation and a clear demonstration of good faith efforts. You can't just claim ignorance after the fact.
Got it. Finally, let's talk about the confidentiality of this information. Once that Form 8300 is filed, who sees it? Where does it go? I imagine it's not just sitting in a file cabinet somewhere.
No, definitely not. And this brings us back full circle to the core purpose of Form 8300, financial transparency and combating illicit activities. While generally, tax returns and related information are confidential under Section 6103 of the Internal Revenue Code. That same section also allows or requires the IRS and FinCEN to disclose this specific information to others for critical purposes.
Who else gets to see it?
It can be shared with the Department of Justice to enforce tax laws, both civil and criminal, cities, states, and U.S. territories, to help them carry out their own tax laws, other persons, but only to obtain information that can't be acquired elsewhere for tax administration, federal, state, and local child support enforcement agencies, other federal agencies for determining eligibility for certain benefits or loans.
Okay, so pretty wide sharing for government functions. What about law enforcement beyond taxes?
Absolutely. Critically, this information may also be disclosed to appropriate state, local, and even foreign criminal law enforcement and regulatory personnel in the performance of their official duties.
Foreign law enforcement, too.
Yes, under treaty agreements. It can also be shared with federal and state agencies to enforce federal non-tax criminal laws and, importantly, to combat terrorism.
Terrorism specifically mentioned.
Yes.
Cool.
And FinCEN specifically can provide this information to officials conducting intelligence or counterintelligence activities to protect against international terrorism, ongoing money laundering operations, or other significant criminal activity.
So this information isn't just sitting passively in a database. It's actively used.
It's actively used across various government levels and with international partners to protect the financial system and national security. It's a vital piece in a much broader, interconnected effort to track and disrupt illicit financial flows globally. #tag outro.
So, what does this all mean? Where does this leave us? It means understanding the seemingly mundane details of forms like 8300 is absolutely critical for, well, pretty much any business taking cash.
It really is.
It's not just about ticking boxes to avoid a fine. It's about being informed, being protected, and honestly, being a responsible participant in this intricate world of finance.
Well said.
We've seen how a seemingly simple concept like cash has surprising layers of definition,
Definitely.
how timely and accurate filing is stringently enforced, and how this one form is a vital cog in the larger machinery of financial oversight and crime prevention. Staying compliant isn't just about avoiding those hefty penalties, it's about safeguarding your business and contributing to the integrity of the broader financial system.
And this deep dive, it really raises an important question for all of us to think about, I think. In an increasingly digital world, where physical cash payments might seem to be declining, though they're still prevalent, where is the line drawn between individual financial privacy and the government's imperative for financial oversight?
That's a big question.
It is. And how might the very definition of cash itself evolve as payment methods continue to change? Think about the rise of cryptocurrencies, instant digital transfers, maybe even central bank digital currencies down the road. How will regulations like Form 8300 adapt?
Yeah, will cash eventually include certain digital assets?
It's something to watch. Keeping a close eye on these developments will be crucial for any business receiving payments, just to ensure they remain compliant with regulations that are constantly adapting to new financial landscapes. And frankly, the ever-evolving tactics of those seeking to exploit the system.
Absolutely. The financial world is always evolving, and staying informed is really your best defense and maybe your greatest advantage. We hope this deep dive has given you a clear understanding of Form 8300 and its broader implications.
Hope it was helpful.
Until next time, think about how these rules might apply to your own business or financial interactions and stay informed.